All right, hello then, everyone. As we look ahead to the week beginning Monday, the 10th of June. Now we'll have a flick across the calendar, see what to expect over the course of what looks like a relatively busy middle of the week, but a couple of different data points to go off, and then we've obviously got the US CPI and the Fed. So, I mean, it may be a slightly troublesome week for trading. I'll explain as to why now in a minute. But today's a bit of a nothing day. You can see Monday on the calendar, nothing really for us to go off over the course of today, and that is reflected in the price. So today was always going to be a bit of a nothing day when you take into consideration what we've got coming through the rest of the week. But we get on to Tuesday, then obviously Tuesday being tomorrow, and we get labour market figures from the UK. Now, this unemployment rate, the Bank of England have kind of told us they don't really trust the labour market figures of the unemployment rate too much over recent months, so they are heavily focused on wages. So you've got these average earnings including bonus, and let me get the low impact figures up just so we can see the other one, average earnings excluding bonus. So we'll keep an eye on these two wage figures as they are kind of looking a little bit more at wages as they are the unemployment. But take into consideration, though, they have managed to get inflation down to where they have got it to without any drastic increase in unemployment and without wages really coming down too much. So, in terms of what that kind of means going forward, I mean, you probably look for some, probably look due to the fact that we're kind of toing and froing as to when we get cuts from the Bank of England. I think the better trade is probably with inflation back at 2.3% and back within their target range. I think any weakening of the labour market is probably a better trade than any strengthening of the labour market. And then mainly these wage figures. Obviously, if the unemployment rate ticks higher, that is a positive. Well, it's not positive for the UK, but it's a positive for us trying to look for trading opportunities. But then these wage figures, if these come in and miss consensus is for both of these to be in line with the previous month. If they both miss consensus, I think it brings forward the prospect of interest rate cuts. That unemployment rate, if that beats consensus, again, it's a contributing factor to bring to the central bank bringing forward the prospect of interest rate cuts. So that's what I'm personally going to keep an eye out for on Tuesday, or tomorrow, should I say. Right, weakening labour market, probably an easier trade than a strengthening labour market due to the fact that inflation is where they want it. You know, I mean, they can sit there and say that wage growth is a contributing factor to inflation. They have managed to get inflation down without wages falling off a cliff. So, it's not a massive deal when it comes to adjusting interest rates, or prolonging interest rates where they are, or cutting them going forward. But it is a step in the direction of cutting interest rates if these come out negative. So that's what I'll be looking for as we come in to 7 o'clock tomorrow morning. Then that brings us on to Wednesday. Right, we've got a few data prints out on Wednesday. We got Chinese inflation, we got UK GDP, we got CPI on Wednesday, and we've got the FOMC. Now, the reason why I think this may be tricky is because we do have updated economic projections from the Fed. Now, I'll release a video on Wednesday. We'll go through this in a lot more detail. So I'm not going to break this down in that much detail today. We'll go into more detail on that on Wednesday. But the issue with this is where you get the economic projections out on Wednesday, right? You obviously get the dot plot, the updated dot plot, but when they would have taken their votes for that dot plot, they won't have seen this CPI print, right? They can get, figures that can project it. They'll have already had that. Of course, they would have access to figures that we don't. But, ultimately, when they do take their votes for that particular aspect of the dot plot, or aspect of the economic projections, the main aspect, which is the dot plot, they won't have seen this CPI print, right? So I think it could be a little bit tricky in the fact that, if CPI comes out and it decides to come in, we'll say higher than anticipated, right? It comes in higher than anticipated. This dot plot won't really take that into consideration. So I think in order to trade the Fed, you probably want CPI in line with consensus, right? Because then it doesn't influence the dot plot as much, and you can kind of take that more at face value. Then going forward, if this either beats, or even if it misses consensus by a massive amount, if it goes one way or the other, the Fed may be a lot more difficult of a trade in the aftermath of it than And then it may be if this comes in line. You've obviously then got Jerome Powell at 7:30. So the more important aspect of this will probably be the press conference on Wednesday if inflation comes in somewhat in line. If this beats or misses consensus, then it's a slightly different trade. But core CPI and then core CPI, mixing up my words, I can't even talk properly today, but core CPI and then total CPI month over month. Core CPI expected is 0.3. Total rate of inflation only 0.1% over the month of May, which is sort of what they will want to see. They will not want inflation to push higher. Right? Is there I mean, obviously, over the last few months, you've had some interesting prints where you've got some weak economic data, but certainly you look back to the manufacturing PMI, not from this month, from last month, that had weak manufacturing PMI, strong inflation figures, strong prices figures. Same thing with the services PMI. Same thing with employment cost and things like that. So you had a few inflationary figures last month. Hasn't really been replicated so far over this month, but some of those prices figures still above 50 in the PMI. So there's still a slight risk for this to be higher than anticipated. I think that's where the more risk comes from the Fed, is inflation continuing to stall and potentially even pushing back higher. So I think especially with strong labor market figures on Friday, if you can get strong inflation figures, they kind of go in line with each other. The idea is to kind of try and find a trend in these things. Obviously, it's a little bit easier said than done, but like a high positive NFP over the course of last week, and then positive CPI. I don't know if positive's the right word, but strong CPI, we'll call it, probably the better tradable opportunity off the back of that, or the more tradable opportunity. But if this comes in line with consensus or even below consensus, should be green light for the for equities to continue to push higher. They even pushed lower after CPI the other day, and then managed to bounce back the full amount. So we'll get on to some charts now in a minute, but yeah, that's kind of what I think from the Fed. Maybe slightly troublesome, because if this comes in I don't think market participants will want to trade this with as much aggression as they would if the Fed wasn't out on the same day. Not something you often see, CPI and the Fed on the same day, but yeah, does it make CPI a little bit less tradable on Wednesday due to the fact that we do have the Fed on Wednesday? It's kind of what I'm thinking, and it is a bit annoying because it's a bit less of a chance to make some cash, but still another chance all the same. And we'll cross that bridge a bit more on Wednesday when it comes to it. But CPI that misses consensus or beats consensus kind of renders this dot plot, I wouldn't say obsolete, but sort of definitely reduces the importance of them. Then we'll rely on Jerome Powell to give us some guidance at 7:30. If these come in line with consensus, then this becomes more of a tradable opportunity. But as I said, we'll do a full breakdown of this when we get to it on Wednesday. You come into Thursday, these employment figures out of Australia, probably tradable data releases. I mean, there's been a lot of positive aspects of the for the Australian dollar over the last number of weeks and probably months. The fact that inflation still hasn't come down. The central bank have considered hiking interest rates. There is no interest rate cuts priced in through to year end from the Australian dollar, and that is, you'd have to imagine, largely reflected in the price. So I do think, on the balance of probabilities, the risks to this are to the downside. So any miss in labor market figures, unemployment rate is expected to strengthen, but I do think the better tradable opportunity comes if you get weak labor market figures that will prompt, or hopefully prompt, some decrease in inflation, which will then prompt the markets to potentially price in at least some of an interest rate cut through to year end. And with it all being priced in the markets, it's kind of against what they were expecting. So I think that's the better tradable opportunities. Obviously, if this comes in a strong labor market, kind of keeps the RBA on that path of refusing to budge on any interest rate cuts and still potentially considering even one more hike going forward. PPI then, producer price inflation on Thursday. We'll touch on that when we get around to it on the Thursday, but we will have the Fed and CPI out of the way by Thursday, so we can do a bit more analysis into how to trade that on Thursday. Sat here at this moment in time, not much point doing any analysis into that until we get through Wednesday. Brings us on to the Bank of Japan then on Friday morning. I'm not sure the Bank of Japan really can do too much. I mean, trading the Japanese yen has obviously been quite tricky. Keep trying to sell the Japanese yen back up to that 160 number. They did intervene previously, so Yeah, we'll have to keep an eye on the Japanese yen, but I can't imagine there will be too much to go off on Friday morning. But I guess we'll have to see when it comes around to that. But they're not going to hike interest rates again. Not going to do any adjustments to monetary policy. Probably just say we're going to ready to take action if needed. But we'll have to see how that pans out going forward, which is kind of means nothing to see there on the Japanese yen. You can see across here, we have a look at markets, pretty choppy across US indexes today, kind of grinding lower. You can see the S&P, the Dow Jones, the Nasdaq, the Russell all grinding lower, probably more brought lower due to the fact that the DAX and the Euro stocks have pushed lower. Emmanuel Macron over in France seems to be losing grip of government, and Le Pen seems to get in. But I was reading a report from was a tweet actually from some French journalist who made quite a bit of sense. I mean, he said the fact that Emmanuel Macron has kind of called for a snap election kind of puts the ball in the public's court. They can go and swap governments and get Le Pen in. But personally, I think French people seem to think that Emmanuel Macron is more of a positive for that country. As if you bring Le Pen in, obviously some prospects will change and potentially even damage ties with the EU and want out of the EU, and say in terms of, or in a similar way to the UK done. And obviously it hasn't panned out too great for the UK since that has happened. So if that was to happen, I think they kind of think it was a bit kind of prudent rather to call a snap election, let the public decide, and then they'll be up for re-election then in 2027, where it may change, and then Macron may get back into, or Macron's successor may get back into to power across France. So they kind of put it down to, do you soak up kind of 2 years of pain for the French economy to then be re-elected then in 2027, and then you can grow then after that, or do you hang on till 2027, allow it to change then in 2027, and then risk another 5 years of a bad economy? Maybe this journalist was a bit biased, but the way he put it kind of made sense when I was reading it. So I'm not going to pretend to be any sort of genius on French politics. I absolutely am not. But kind of to my research, and certainly way the markets have moved, I mean, what he said made sense, but then markets have kind of moved in line with that. You can see the DAX, the Euro stocks, pushing lower. If I change this to the CAC Courant, you can see the CAC Courant has certainly not enjoyed it over the course of last night as well. You can see straight away when it opened, futures trading open this morning, it was down 2% in an hour. So certainly not a positive across the French economy. Markets not really, or French not really, or Europe, sorry, not really liking what happened over the weekend in terms of France. And the euro has sold off this morning as well. With that, you're going to have to put downside in the euro down to what happened over the weekend, due to the fact that none of these other US dollar pairs have done much over the course of the last number of hours either. So a bit of a chop sideways in US dollar, absolutely to be expected once we have a look at the calendar and see what's going on through the rest of the week. An interesting one, that bond yields kind of went through the roof off the back of Friday's NFP. That should spark a bit of positive, or did spark a bit of positivity in the US dollar with NFP as well. Stocks kind of, once you come back here, they kind of sold off initially, then bounced back to the highs, and they've just kind of been chopping sideways ever since. So positive US dollars off the back of that. We're probably going to look for CPI to go in the same way, as we do want a trend in this economic data, although economic data throughout the US has been mixed over the last month or two. Let's see what the Fed have to say on Wednesday. But in terms of where to go about markets for now, I think European assets are probably your focus until we get into Wednesday. Obviously, you mix that in with UK unemployment figures tomorrow. So don't think it's going to be too easy of a trade throughout the US related markets until we get into Wednesday. Even then, it might not be easy. Well, no trading is easy, but you know what I mean. But tomorrow morning, UK data, will keep a close eye on that. And for now, you have to imagine European assets remain bearish. But we'll update on all this stuff as we get out through the week. We'll have previews and stuff. But so stay tuned on the social media channels, and we'll update as and when we get to it. But best of luck everyone out there this week. Few opportunities to make money. Best of luck if you try and take advantage of them, and we will cross the bridges when they come to them.